We have an outside day here yesterday, big down close day. An outside day is a day that's higher than the previous day and lower than the previous day's low. So here's previous day's high, it went higher. Here's previous day's low, it went lower. So all of this range is outside of the previous day's range, and it closed down. When this happens, there's typically this type of price action formation, but it's really included with the odds in your favor if you're trading down to an all low but fall short of it. Okay, this is usually where that double bottom idea comes in, and it feels safe to, if you're trading like me, look for a run through that old low. But if they stop it short, it tends to be a choppy day. So let's go into an hourly chart. All right, so here's the price action for today. We're going to look inside this tiny little fractal right here. So we have old highs in here. If you look at the high here, it comes in at 39.33 and I built the idea that looking at price, studying in the way that I teach it, it would be very easy to fall victim in this type of trading day, where it's choppy, it's listless trading back and forth, and how to anticipate it, what to look for. And I want to go into the 5-minute chart real quick. So here is the 39.33 level. This is the low at 38.72 and the old low on the daily chart that did not get traded through is at 38.55. And notice we just fell short of reaching that at 38.56. So we went one handle short of that, started trading higher. And I mentioned how the market many times can present opportunities that look like it's likely to form a setup, but it really doesn't really come to fruition. And if you look at this fair value gap right there, okay, how we traded up into it, started working lower, created a small little fair value gap in here, bumped into that, traded lower, nothing really in here to work with in terms of the model. So nothing here is a short. We were talking about all of that this morning. So as the market was trading around in this area, I mentioned how it was likely to be a 50-50 probability. That means it's likely to go higher just as well as it is likely to trade lower. Okay, so what's the benefit in that? Obviously, anybody can come into it with a 50-50 expectation, but it really statistically moves to 50-50 when we start trading back into the middle of the range. Okay, so this imbalance here, the fair value gap, it should have offered a little bit more movement lower. Why wouldn't it go down and take out this short-term low? It went below this short-term low here and then started rallying, working towards the relative equal highs are here. But we have to take every single trade idea based on its current dealing ranges. And what's a dealing range? Well, a dealing range would be like from this high down to that low, and we measure those. Yes, it trades up into that imbalance and trades down to a short-term low. That's a tradable opportunity there, but it's not very clear after that. It just goes back and forth, chopping. Short-term lows are taken, high is taken here. We trade back and forth. All of this is really ugly type of price action. And I mentioned that we would go to 39.33 back here, and it ran right up into it, cleared those relative equal highs, broke down, traded back down into the range. And I started talking about how the real setup that would be formed by my content, by the things that make sense in the algorithm, would deliver a specific framework today. Take a vertical line and add it to 3 o'clock New York local time and 4 o'clock. And that would be the setup that forms to take us back down into the middle of the range. Now, I tell everyone in the tweets to study the middle of the daily range. Okay, so what does that mean? If you look at what the high was and the low, okay, right in here, that's the middle of the range. We ran above the short-term high. So we have relative equal highs here and relative equal highs here. So there's buy side resting here. I outlined how the market would use the running up to take out the buy stops, to squeeze anybody that was short and trail their stop loss down, and also to induce people into thinking it's going to go higher. So that way it builds up liquidity below these lows. What kind of liquidity? Sell side liquidity, because they're going to protect their long positions. But the main thing was focusing on the middle of the range here. So if we're looking for setups that are going to be based on a run above for buy side and pull back into the range, it needs to be specific in terms of time. I gave a very specific window between 3 o'clock and 4 o'clock in the afternoon. So we go into not an hour chart. We're going to go into a minute chart. You can see here, the market rallies above, bumps into the buy side liquidity. Smart money uses that to go short. Here is the breakdown here. Let me take this over here a little bit. Is this a swing low? Yes. Is this a fair value gap? Yes. Does it trade back up into that range? Yes. It works lower, back into the middle of the range. On days like this is called a consolidation day. And what happens is this. The market starts trading, creates an initial range, and then stays in that range until the afternoon. At 3 o'clock, it used to be the bond close that started this whole thing, but now it's just 3 o'clock to 4 o'clock when equities close, the closing bell. That sets the tone for on-close orders. So what that means is, what was going on prior to 3 o'clock? The market was rallying up. What did it go up for? The buy side liquidity. But traders are going to look at that as a breakout to go higher, and they're going to pair that with the market participants that are considered smart money. The logic I was teaching was that would be utilized for smart money at the close between 3 o'clock and 4 o'clock. So they ran it up there. All the buy orders that were resting above here are here in the form of protecting short stops, or not short stops, short positions, acting as their stop loss order. When the market trades above that, those buy stops that are protective in nature, they become a rushing liquidity wave, okay, of willing buyers at the market. So willing buyers at the market at 3 o'clock on a day like this where it's consolidated, it's going to want to go back to the middle of the range. So when you look at that type of event, it's going to range bound trade between, here's the 930 or so right there. Okay, so the low of the day there and the high of the day there. So split that in the middle. There's your midpoint, and it's going to want to gravitate back to that. So when you look at price action days like this, and if you're caught up in it, you don't know what you're doing, or you feel like it's just being chopped up, wait until 3 o'clock. Because many times at 3 o'clock to 4, the algorithm will do something where it goes outside the bounds of the daily range, like it did here. Okay, it trades up into it and then rams it down, and nobody's really allowed to make any money. Anyone that was long breaking out here gets raked across the coals. Anyone that's short gets knocked out with a stop loss and a losing position.